markets at the moment. So CoreLogic is a fantastic supporter of PIPA, a corporate member of the association, and we're really thrilled to be able to have Tim as a great resource to give us the insights around the different marketplaces as they stand at the moment. In regards to getting started, we're going to get started shortly. What I'd like to do is keep the questions till the end. So if you do have a question and you're new to go to meeting webinar or go to webinar as they call it, then just jot down some questions in the chat box. I'll have a look at some of those questions and we'll be able to organise those. So what I want to do now is hand over to Tim and listen to his great insights, and then we'll take some questions after Tim's presentation. So handing over to Tim.
Great, thanks Ben, and it's always good to be here talking to the PIPA members. So thanks for inviting me along. Hopefully everybody can hear me okay. I'll presume that you can, and I'll keep on going, and hopefully you can see the screen as well. It's always a little bit hard with this sort of technology where I'm not too sure what I'm broadcasting, but I think I'm doing it right. So guys, the presentation I've got today obviously is an update on the housing market, and it probably couldn't come at a more interesting time. We're seeing, I think, the market moving through an inflection point at the moment on the back of a lot of regulatory changes, a lot of media as well. I think it's every day we're picking up the Fin Review or the Australian at the moment, and there's another article about housing affordability or what to expect in the budget, or the fact that the housing market's moving through a peak and so forth. So I think we're really starting to see the housing markets becoming under a lot of scrutiny, much more so than it normally is, at least. Okay, and as Ben said, guys, there's time for questions at the end. I will fly through a few of the slides, and I'll spend a bit more time on the other ones that are more topical. But if there's something that I've skipped over a bit too quickly, guys, just flag it at the end, and more than happy to address that as we go through. Okay. So,
Tim, can you make sure that your screen's on?
Yeah. Yep, my screen is on. Can you guys see the presentation?
Unmuted.
Yes.
Yes, good, thank you.
Right, I just turned it off and back on again. Okay, so the first slide is just an update of how the housing market's values are faring compared to the other. Probably familiar with this slide. And if I could just ask anybody who's not on mute, just to go on mute for the time being. Great, thank you. So the current estimate we have on the asset class is $7 trillion. It just clicked over to $7 trillion at the end of last month. So we're looking at a very large asset class, obviously not just increasing the overall value through capital gains, which has certainly been a contributor, but also through a great deal of new construction that's happening. I'll be touching on supply levels a bit later in the presentation as well. Okay, so let's look at value growth first. So on slide 3 here, and what we're seeing at the moment in the housing market is a real acceleration or a re-acceleration of the rate of capital gains. This data covers up through to the end of last month, so through to the end of March. And what we're seeing in the meantime, since we published this data, is there does seem to be a bit of a slowdown based on our daily index. In fact, looking at the month to date so far, we've actually...
Tim, it's Ben interrupting you, mate. We're getting a lot of, can't see the screen. So Karen, if you're listening, can you just check to see whether you've given Tim permission to share his screen? Are you working off a dual monitor, Tim, or are you working off one monitor?
Yeah, I've got a dual monitor, but I've shared the right screen shared. Can anybody else give any feedback on what they're seeing?
I've got a message coming up here saying waiting to view Tim Lawless' screen. So PIPA, CoreLogic National Market Update, organiser Kate Miller's ID number and then waiting to view Tim's screen.
Okay, I can see a lot of people saying they can see it. So there might be a few technical issues on the other end.
Yeah, it's interesting that. So we have some saying yes and still plenty saying no. I've got my guys listening in another room here, so I might just quickly wander around there. Tim, you keep talking, but I'll see if we can work it out whether it's the user on our end or whether it's a fault that we've got going at the moment. So just give me a second. You just keep talking to the broader market, and we'll see if we can sort this out.
No worries. For the people that can't see it, just make sure you've got the right Citrix applet installed. There may be a little box that popped up that says just install this this piece of software. Okay,
yeah,
but the people can
the Citrix one, you wouldn't be able to get onto the meeting, I wouldn't have thought, unless you had the Citrix already successfully downloaded. But I'll just check with my guys. Just give me a second, but keep going, Tim.
Okay. So, okay. So David's saying he's disconnected and rejoined, and it's fixed it. So it looks like I'm presenting it right. Sorry about that, guys. And I'll just ask everyone to go on mute if that's okay. Okay. So I was just touching on the most recent data we've seen come through. Sorry guys, if you're not on mute, just go on mute please. Thank you. So the most recent sets of data since we published in March is definitely showing a slowdown. In fact, I think when we actually publish our April results on Monday, we're likely to see, so there's a lot of echo going on now as well. We're likely to see the fact that Sydney's actually a very flat market over April. Melbourne has slowed down to about 0.5% growth over the month. Perth is still in decline, and we're seeing some very modest growth in Adelaide and also in Brisbane. But it does absolutely look like we're moving through an inflection point, not just based on our hedonic index data, but also auction clearance rates have been a little bit lower. We've seen a subtle rise in listing numbers as well, which means some of the urgency may be coming out of the market. And also we are, of course, seeing a lot of other regulatory changes and higher mortgage rates and a bit of a dent in housing market sentiment as well that's likely to be impacting on the housing market. So those people that can see the screen, I'm just moving on to page 4. And what we're seeing here is the real, I suppose, evidence of the two-tiered market conditions that we've been seeing since the onset of the GFC recovery. So since 2009, this has really been a story of Sydney and Melbourne. In fact, the growth phase between 2009 and 2010 was much more a Melbourne-dominated market in terms of capital gains, with Sydney playing second fiddle. But the most recent cycle, which is June 2012 through to now, has been very much dominated by Sydney. In fact, we see that Sydney dwelling values are up by 110%. Since the beginning of 2009 now, and Melbourne dwelling values are up by 92%. Okay, every other capital city is still seeing growth, at least over this long time frame, but substantially lower than what we've seen over the marketplaces in Sydney and Melbourne. We are seeing some other smaller markets now actually gathering some momentum. We've seen Hobart and we've seen Canberra really starting to lift their pace of capital gains. They've joined the party quite late, but we're now seeing both those markets achieving double-digit growth over the past 12 months and not seeing any real sign of those markets slowing down just yet. So I think the slowdown we're seeing over April has been much more reflective of Sydney probably moving through the peak of the market and secondly Melbourne showing a slowdown as well. A whole bunch of things are factoring into that slowdown. Of course, it's affordability, it's the regulatory changes, it's higher mortgage rates, which are slowing down investment to the market. And of course, with most investors heavily concentrated in Sydney or in New South Wales, this is the state of the housing market that's probably going to be most susceptible to a slowdown in investment demand and investment lending. Okay, on page 5, just drilling a little bit closer to some of the data, just looking between houses versus apartments, and you can see some really interesting trends. For starters, in Sydney, there's not a great deal of difference. We're seeing house values and unit values broadly growing at about the same pace of growth, around 15 to 17% per annum. Whereas in Melbourne and Brisbane, where there has been a lot more concern around higher unit supply levels, that's probably affected sentiment, as well as the real effect of higher supply levels dragging things down. You can see in Melbourne, for example, house values are rising at about 16% per annum, and unit values are rising by about a third of that rate, about 5%. In Brisbane, even though the market conditions are still relatively mild, we're seeing house values rising at about 5% per annum, whereas unit values are only rising, or they're virtually steady, moving sort of between slightly negative and slightly positive in that marketplace. I'll touch a bit more on supply and some of the other indicators a bit later on, and we are seeing quite a few indicators that are suggesting that the unit markets in Melbourne and in Brisbane are being affected by, probably more so by weak sentiment, but probably realistically also by the higher supply levels coming into the inner city areas of those markets. Now, there's been a lot of discussion around affordability, and as I move into some of the graphs around affordability, a good segue is just looking at a geographical spread of housing values across the 3 major capital cities. So the graphs or the maps you can see in front of you is Sydney on the left, Melbourne in the middle, and Brisbane on the right-hand side, and the thematic shading is the median house value across each of those cities plotted at the suburb level. So any of the shadings that are really deep dark shades of red is where the median house value in that suburb is at least $1 million. So you can see pretty clearly that even though incomes are higher than most other areas in Sydney, still pretty tough to find a detached home within 20 kilometres of the CBD that's under $1 million across Sydney. Melbourne shows that same trend, but to a much lesser extent. You can see those very expensive suburbs are much more clustered around the eastern and bayside areas, as you'd expect. Many of those blue chip areas, and even within the 20-kilometre ring, which those buffers on each of the maps is 10 kilometres, 20 kilometres, and 50 kilometres. Even within the 20-kilometre ring in Melbourne, there's some greens and yellows coming into the maps, which suggests that areas around, say, Wyndham and Melton, for example, are still reasonably affordable and have reasonable transport connections coming to those areas as well that do make them quite desirable for first home buyers. Whereas in Brisbane, very few areas are that really deep, heavy shade of red. We're seeing affordability in Brisbane not really that much of a challenge compared to, say, Sydney or Melbourne. So in some of the measures of affordability that we have, probably my go-to measure would be the dwelling price to income ratio, and it really does highlight that housing affordability is most challenged in Sydney. The dwelling price to income ratio there is 8.4 times, which means the typical dwelling in Sydney is about 8.4 times higher price than the gross household income in the same region. Okay, those measurements do vary quite a bit when you drill down to smaller aggregations, and you do tend to find that affordability is most pressing the closer you get to the city, even though incomes do tend to scale upwards closer to the city as well. But of course, a lot of the price growth we've seen across Sydney and in Melbourne has been very much centric to those inner city, and then more recently rippling outwards to the middle ring and then gradually the outer ring suburbs as well. Whereas if you look at markets like, say, a Perth or a Brisbane, the dwelling price to income ratio is much less challenged. We're looking at income ratios or dwelling price to income ratios there that are below 6 times, and certainly improving even further across Perth on the back of lower home values and some subtle income growth coming through that marketplace. Brisbane pretty much flatlining in the high fives there, and Melbourne trending a little bit higher. We're about to release some updated figures for affordability, by the way, based on December data, and we should have a March affordability report in the marketplace, partnering with one of the banks towards the end of May, if not in early June. So another way to measure affordability, of course, is not looking at dwelling prices to incomes, but looking at the actual serviceability of mortgages. Now you can see, because mortgage rates have been very low, we're still seeing mortgage rates, even though they have edged a little bit higher, they're still the lowest we've seen since the 1960s. If you look at, once again, at Sydney, it still stands out as being the more unaffordable marketplace, with the average household dedicating nearly 45% of the gross household income per annum to servicing an 80% LVR mortgage. So remember, there's an old rule of thumb that if you're dedicating more than 30% of your annual household income to servicing a mortgage, you're in mortgage distress. It probably doesn't hold a great deal of truth anymore, to be honest with you. I think even looking back to, say, 2006, 2007, you can see, despite the fact that mortgage rates were substantially higher at that time, and dwelling prices were substantially lower, the typical household in Sydney and in Perth, was dedicating more like 55% of the gross annual household income to servicing a mortgage. So the fact that we have seen mortgage rates come down quite substantially is really one of the saviors to a serviceability measure like this. But of course, we wouldn't expect interest rates to stay as low as what they are forever. In fact, we're already seeing mortgage rates edging higher, and I think for most people, a better interpretation or a better measure of affordability absolutely comes back to the dwelling price to income ratios, which don't factor in the serviceability component. Even though it is an important part of owning a home and paying down a mortgage, for first home buyers, for example, they're finding the deposit hurdle, which has nothing to do with interest rates, is becoming increasingly difficult. Finding a 20% deposit when the typical house value in Sydney is getting around $1 million is increasingly difficult. So speaking of first home buyers, on page 9 now, you can see the effects of affordability pressures on first home buyers. New South Wales first home buyers are about 7.5% of all owner occupiers. If you make some assumptions, in fact, for investors here, first home buyers in New South Wales are probably more likely to be around about 3 to 4% of mortgage demand in that market. Of course, that's not including first home buyers that are buying as investors. They're not counted in the Australian Bureau of Statistics data. So I think anecdotally, at least, we are seeing a rising prevalence of first home buyers that are willing to keep on renting, but their first home is actually an investment property, or it's an investment property that's even remotely located. It's in another city, or it's in a region that they're not generally willing to live in, either due to commuting times, or they want to be close to their friends and family, or closer to where they work and where they play. Okay, in some markets, like look at WA, we are seeing an improving level of first home buyer activity based on the mortgage data, or housing finance data from the ABS. This probably comes back to the fact that affordability is improving, and even during a time when affordability was quite tough, we were seeing first home buyers still relatively active in WA. Maybe it comes back to some of the shared equity loan arrangements the WA government has on offer. Okay, but still pretty strong presence in the marketplace in WA. It's at just over 20%. Also, first home buyers increasing in Queensland as well, but generally very low in South Australia, New South Wales, and to a lesser extent in Victoria. Okay, let's have a look at some of the stock on market figures here, and the listing data I'm going through at the moment really does provide a strong hint on where the marketplace is getting some of its strength from. So I'm starting with a national graph here, and the way to read this graph is simply each of these trend lines represents a calendar year of total advertised stock on a rolling monthly basis. Okay, you can see 2017 has once again started the year on a footing with listing numbers very, very low compared to where they were even the previous year, not to mention, say, 5 years ago. So the fact that we are seeing listing numbers very low in the marketplace is adding to this sense of urgency that a lot of people feel, particularly in markets like Sydney and Melbourne, what they call FOMO, the fear of missing out, right? I think it's one of the things that are driving the very high clearance rates we've been seeing in Sydney and Melbourne and Canberra, and also the rapid rate of sale, which then obviously places some upwards pressure on prices as well. So if you look at Sydney and Melbourne listing graphs, you can see what I mean, right? Listing numbers are very low. In fact, in Sydney, we're seeing about 20,000 properties being advertised for sale over a rolling monthly basis. That's nearly half of what it was, say, 5 years ago, and it's actually fewer listings than what's being advertised in a market like Perth. So this is where some of the urgency is coming from in markets like Sydney and in Melbourne, shows a very similar trend. More recently, though, during April, we've seen Sydney listing numbers actually moved a little bit higher than what they were last year. Haven't seen that for quite some time. So I think, once again, that does suggest that we are seeing Sydney just slowing down a little bit. You know, listing numbers, even if they are higher than last year, they're still extremely low from a historical perspective. So there's still a shortage of stock on the marketplace. But if we do start to see that trend continuing, it does mean that buyers will have some more options, probably less urgency to make a purchase decision, and we may see a bit of a dampening effect on some of the other indicators like clearance rates and average selling time as well. In fact, last weekend we saw the Sydney market record a clearance rate down around the low 70% mark, and generally, at least week to week, so far this year, Sydney clearance rates have generally been in the high 70s to low 80%. So quite a difference in last week's auction clearance rate reporting. If you look at some of the weaker markets, Perth is probably the best example, where it is absolutely the opposite of Sydney. There's no urgency in this market. Prospective buyers have a lot of stock to choose from. They don't need to rush into the marketplace. They can make their purchase decision with quite a bit of time, and if they don't get the right price for a property, they can simply move on to another one and negotiate really hard. So this is one of the reasons why there's very little upwards pressure in the Perth marketplace, and also why homes are taking a very long time to sell and vendors are having to discount their prices quite substantially. I think you could describe this as a buyer's market. Absolutely. It's very much the opposite of, say, Sydney or Melbourne, which I think are absolutely still sellers' markets, even though we have seen just some recent subtle softening in those regions. So to sum that up, you can see vendor metrics. The markets that are very hot, your Canberra, Melbourne, Sydney, Hobart, are all showing very low levels of discounting rates, below 5% in each of those markets. Canberra's always shown a very low discounting rate, even when the market's been soft. Vendors were hardly discounting their prices. But in Melbourne and Sydney, seeing a discounting rate that's below 5% is still very strong. An average selling time that's around about the month mark, so 29 to 30 days, also does suggest that these markets continue to be very strong for selling conditions. It's interesting when you see some of these vendor metrics that we don't actually see more vendors rushing into the marketplace. And I think there's a few obstacles for vendors to actually be putting their homes in the marketplace, which tend to be the transactional costs, and also just fear that if you are selling your property, what if you get priced out of the marketplace in the meantime when you're trying to rebuy? So that whole paradigm of selling first and buying second does seem to have gone out the window a little bit, where more people are buying first and then looking to sell their property to make sure they don't get priced out of the market. Okay, move to the next slide, guys. Clearance rates, pretty self-explanatory. I'll move through these slides a little bit quickly because I want to make sure we have time for questions at the end, guys. The most recent clearance rate data, as I mentioned, does show a little bit of a dip as we saw a slightly weaker rate of clearance, but in the grand scheme of things, we're still seeing clearances relatively strong, particularly stronger than where they were a year ago. So let's look at supply, which obviously is very topical due to the fact that we're seeing a lot of units being constructed and settling now in the marketplace. These two graphs are based on Australian Bureau of Statistics data, and they track commencements on the left-hand side and completions on the right-hand side. So it's pretty clear to see how substantial this boom in unit development has been. If you look at the house trend, we've seen detached housing peak at roughly the same levels as what we've seen over previous cyclical highs. Whereas for the apartment sector, the typical construction cycle has peaked at around about 10 to 15,000 apartments commencing or completing, whereas at the moment we're seeing that roughly double, getting up around the 25 to 30,000 mark. Okay, so it really does highlight that this is really an unprecedented level of unit supply we're seeing coming into the marketplace, not just approvals, but also stock that's actually commenced and is completed, and arguably even more importantly is how much stock is currently under construction, which is what this current slide number 16 is looking at. So when you see a graph that's so substantially vertical like this, it really does suggest that there's something interesting going on. So we're currently seeing about 152,000 of units that are under construction. Okay, this is where they've turned soil and the units are currently being built. And of course, as these units start to progress out of the construction phase, they'll hit the settlement phase. And this is where we're suggesting there may be some problems, particularly for some of those very much investment-based, undifferentiated high-rise apartment towers that have sold off the plan, where we're already seeing some evidence that the off-the-plan valuations are coming in less than the contract prices. So I'll just skip over the slide really quickly and go to some of the more detailed data. What we're seeing in terms of unit supply is really interesting. When we drill down to an SA3 region, which is an aggregation of suburbs, it's a formal statistical boundary that Australian Bureau of Statistics use, you can start to see where a lot of the supply is coming online. So it's Melbourne's inner city and Brisbane's inner city. The next 24 months, we're expecting around about 14,000 units to settle. In Melbourne's inner city region and Brisbane's inner city, it's about 11,000. But probably more importantly is that final column on this table, which is what does that stock uplift represent in terms or compared to existing stock levels. And you can see in Brisbane's inner city, it's more than a third uplift in 2 years compared with what's currently in the marketplace, or what's currently established in the marketplace. So this is where we start to see there is a bit of supply shock coming into the marketplace. It doesn't mean that every single apartment development in inner Melbourne or inner Brisbane is a no-go zone. In fact, there's plenty of very healthy projects that generally the healthier projects tend to have some level of differentiation about them, either through their target markets, they're not solely driven by investment, by their location. They may have a better site, maybe is waterfront or elevated or has better views or closer to the amenity and so forth, or they're differentiated based on the levels of fixtures and fittings and so forth as well. So it's those projects that do seem to be much more resilient to undervaluations. So speaking of undervaluations, on slide 19, you can see some of the evidence that we're looking at here. We've taken this data from our Valex platform. So Valex and VMS are two valuation platforms that account for a little bit more than 95% of all bank valuation instructions. And we've just extracted some of that data for off-the-plan unit settlements. So what you can see on this data is that in Sydney, for example, there's no real issues. We're seeing, about 18% of unit valuations at the time of settlement coming in under contract price, but the vast majority of those undervaluations are immaterial. They're kind of like 0.5% to 1%. There's no problems. Whereas in Brisbane, Melbourne and Perth, we're seeing more like about 40 to 45% of off-the-plan valuations at the time of settlement coming in under the contract price. Starting to improve a little bit in Perth. Okay, that's because the Perth construction cycle did peak a lot earlier than in Brisbane and Melbourne. So I think we're moving through some of the pain, but still at 40%. But once again, even though we're seeing about 40 to 45% of off-the-plan valuations coming under contract price, the vast majority of these undervaluations aren't material. It's about 10% of them, or maybe even 11 or 12% now, that are coming in at more than 10% under contract price. And that's where the pain for the settlers is absolutely most concentrated. So if you imagine if you get your contract, your valuation at the time of settlement is 10% below your contract price, you generally have a bit of a finance shock because you probably need to top up your commitment to the bank to meet your 20% loan to valuation ratio. And most people don't want to walk away from a 10% down payment as well. Plus, of course, developers will generally try to sell that stock, and if they sell it for less, then generally the contract holder is liable for the price difference. We're also seeing some evidence of weakness in the apartment sector based on our pain and gain data. This is data that traces the proportion of profit and loss-making resales. Okay, this is based on data up to the December quarter. Once again, Sydney's not showing any issues whatsoever, but in Melbourne and Brisbane and Perth, we are seeing a fairly substantial divergence in the proportion of loss-making sales within the inner-city apartment markets. So in Melbourne, it's not too severe. It's about 10% of all resales of inner-city apartments were loss-making, but in Brisbane, it was closer to 20%. In Perth, it was closer to 35%. In each of those markets, showing a much more substantial rate of loss-making sales in apartments compared with detached housing. Okay, and finally, let's look at investors. Investors, obviously, one of the topics of the day at the moment, particularly on the back of the APRA regulatory changes, where back in 2014 they announced the 10% speed limits, which resulted in a slowdown of the marketplace through 2015 and the first half of 2016. But more recently, obviously, APRA are targeting interest-only loans, and I think anecdotally at least, it's probably still a bit too early to see true evidence of this, but I think we're already seeing the fact that banks are putting up their mortgage rates for interest-only loans and for investment loans. That's starting to impact on investment demand in the marketplace. So you can see investors, based on this data, for a long time there, were tracking higher than owner-occupiers. The most recent set of data shows that investors are starting to ease a little bit in terms of the growth, but still roughly around about 47-48% of new originations, not including refi as well. So normally I'd expect investors to be around about 33 to sort of high 30% of the market. So to see them closer to 50%, even closer to 60% in Sydney, is one of the reasons why the regulators become a little bit uncomfortable. So while investors are still very strong in the marketplace, but easing a little bit, this is happening while rental conditions are pretty soft. You can see the annual change in weekly rents. Even though rents are starting to show a little bit of upwards pressure now, which is a bit of a change, you know, it's still showing rental growth is substantially lower than dwelling value growth, which means that rental yields on the right-hand side are still getting compressed. In fact, Sydney and Melbourne are generally reaching new record lows each month for rental yields, tracking around about the 3% mark gross. Now, of course, houses about 2.7%, units getting a little bit higher than 3.5% in those markets. So you net those yields out, and you're looking at net yields that are probably closer to around about 2% for detached housing, probably about 3% for units. So it does suggest that most investors will be utilising a negative gearing strategy off the bat for at least the first few years until they start paying down the principal, which makes the negative gearing debate very important. Of course, you don't want to turn investment off at a time when we're moving through an unprecedented apartment boom, and also at a time when we're seeing some renewed upwards pressure on rents as well. Okay, so just to sum up some of the regulatory changes and the benchmarks that APRA are using, you're at the 10% speed limit there, which you can see on the top left. So even though the investment credit growth has well and truly met that 10% speed limit, if you look at the monthly growth data, which is on the bottom left-hand side, there has been some acceleration in investment credit growth, which is one of the reasons why APRA was getting uncomfortable. I think that they probably will see a slowdown in that rate of credit growth now that they've been quite verbose in mandating a slowdown through interest-only loans, which are very popular with investors, of course. But you can also see those numbers I was talking about for investment by state. Yeah, the latest data up to February was showing that investors comprise 57% of new mortgage demand, excluding refis, of course, in New South Wales. So well and truly above where you'd normally expect it to be. We're also seeing lenders requiring larger deposits. You can see it pretty clearly in this APRA data. where the proportion of loans written on an LVR between 60 and 80% has risen to being more than half of new mortgage originations, and those loans that are on LVRs of greater than 80% are certainly diminishing. So it does highlight that banks are becoming a little bit stricter in their lending criteria. They're becoming stricter in their lending and serviceability policies as well. You know, if you're an investor and you want to factor in your negative gearing benefits, generally that's going to be pretty hard these days to factor that in on your serviceability calcs. Same with factoring in rental increases and also no vacancy for your rental properties. The banks are generally pretty conservative, it seems, when it comes to utilising rental income as part of the serviceability calcs. And of course, you can see the mortgage rates, the premium being applied to investors now has grown. We're seeing investors now facing about a 50 to 60 basis point premium on their mortgage rates, and that may become a little bit larger when we see the April data published by the RBA, because there's been some further movements in investment-based mortgages during the month. And finally, we've got household income to debt levels. This is one of the factors the Reserve Bank, of course, has been talking about a lot, is that household debt levels are quite extraordinary, unprecedented. We're seeing a household debt to income ratio that's nearly 190% now, and about 70% of that household debt is housing related. So you can see why households are very sensitive to the cost of debt, sensitive to interest rates. That's not going to come down very quickly, but you'll find that
Tim, can you hear me? Can everybody else hear me? This is Ben Kingsley speaking.
I can, Ben. Jerry?
Tim, can you hear me okay? We're not getting a reply from you, Tim. We seem to have lost your audio. Your slides are still up, but we're not getting audio sound. Tim, can you go to the chat box and confirm that you can hear me? Tim, can you confirm that you can hear me via the chat bot, please? It looks like Tim has checked out and has now checked back in. Tim, can you hear me okay?
Yeah, sorry guys, I'm not sure what happened there. I just had to restart it. I'm back.
So just to let you know, Tim, we lost you at slide 27. So if you can go just back one slide, please.
Okay, sorry about that, guys.
That's all right.
You can let me share my screen again if you like. I think you just need to let me share my screen. It's, I was talking about population growth and the fact that we have seen a real slowdown in the mining states. Can you hear me all right there, Ben?
Yes, we can hear you. The sharing screen, we're just waiting for that to come back up. So.
Okay, my screen should be shared now, guys. Sorry for the technical issues.
Yes,
okay, so
fantastic.
Slide 27,
yep.
I'm just talking. Okay, I'll continue on. Population growth. This is one of the more important factors of housing demand, and it really highlights that the non-mining states, in New South Wales and in Victoria, they really haven't seen any slowdown in population growth. In fact, Victoria's moving to new record highs in interstate migration, up until just recently at least. And New South Wales also been seeing very strong migration rates as well. Whereas if you look at the mining states, look at Queensland, look at Western Australia, particularly Western Australia, and you can see that there's been an absolute fall away in housing demand. In fact, in WA, it's pretty much a cliff face and it's showing no signs of turning around just yet. This is one of the reasons why the WA marketplace is showing such weakness, is the fact that we are seeing interstate migration rates so substantially negative. In fact, they've never been this severely negative on any occasion. So Queensland, probably more positive. We're seeing a turnaround in interstate migration. It never went negative. And I think this upswing in both overseas and interstate migration into Queensland is going to be a real positive for the housing market in Brisbane and more broadly in southeast Queensland for that matter. Okay. So just summing up, guys, I know we've got limited time for questions, so I might let you guys just digest the last slide here, my outlook. But overall, I think we're probably moving through the peak of Sydney and Melbourne's market right now. When we publish our data on Monday for April, what our data is going to show is that Sydney was either flat to slightly negative over the month based on our hedonic index. Melbourne's probably up by about 0.5%, which is well lower than what we've seen over the previous, say, 6 months, where generally month-to-month growth has been around 1 to 1.5, even 2%. So a real slowdown in both those markets, not just in their indices, but also auction clearance rates. Mortgage activity seems to have taken a bit of a dent. And if you look at the latest Westpac housing sentiment data, it seems that sentiment's taken a bit of a hit as well. So I think on the back of the regulatory changes, the fact that mortgage rates are starting to rise now, particularly for those investment-centric loans, then we are going to be seeing an ongoing slowdown in conditions. But we're not predicting any real crash in the marketplace. Go back through the cycles and you'll see they generally are fairly controlled. And I know the Reserve Bank and APRA will be doing their best to ensure this is a controlled slowdown, just like every other cycle. So I'll hand it back to you guys there. I think we've got some time for questions. I'm happy to stay a bit longer, considering we've had some issues. But so I'll open up for questions.
Thanks, Tim. So just how we'll handle this, because otherwise we'll get everyone talking over each other, is if you wanted to write your question down in the chat section and send it through, Tim obviously can see the questions in the chat box. Can you see those, Tim?
I can. I see Julie's question first.
So we'll just do a few of those. Obviously we won't be able to get to everyone's questions, but this is your chance to get some insights from Tim and qualify some of your questions. So we really appreciate you hanging around a little bit longer, Tim.
Okay, great. So Julie Cumming, I'll go to your question first. So Julie's asked, what do you see as the forward projections for Brisbane housing and Gold Coast housing, not units? Well, interestingly, the Gold Coast has actually been a stronger market than Brisbane over the past 18 months or so, and same with the Sunshine Coast. So we're seeing growth of around about 5 to 7% on the Gold Coast, Sunshine Coast markets. And I think the growth rates in both those lifestyle markets will probably improve. Even if we do see Sydney and Melbourne moving through their peaks, I wouldn't be surprised if we see a lot of those lifestyle buyers cashing out of Sydney and Melbourne and looking towards those lifestyle markets in coastal areas. Byron Bay would be another great example where values are rising quite swiftly. Brisbane, on the other hand, doesn't seem to have shown as strong a growth rate in detached housing. Generally, values rising around 4 to 5% per annum. But when you start drilling down, Brisbane's a really broad area. It includes Ipswich, it includes Moreton, it includes Redland and Logan. But when you look at the Brisbane local government area, that's where the growth seems to be in the marketplace. In fact, within that 10-kilometre ring, you're probably looking at growth that's closer to 10% per annum now, I would assume, without having any firm data in front of me to back that up. We are seeing homes selling pretty quickly in that 10K ring, and absolutely affordability within that 10K ring is substantially better than what we're seeing in other major capital cities. And I think they're probably, those three areas, Gold Coast, Sunshine Coast, and that 10K ring of Brisbane, are probably going to be the best marketplaces for capital gain around the southeast Queensland area. Hope that answers your question, Julie. Then Nicola had a question. I note that about 20% of all new mortgages have LVRs of 80/20 or higher. So it would seem that most borrowers are in a secure financial position to see them through any market softening, contrary to some media reports. Yeah, absolutely. Some of the media reports that talk about the buffers that have been built up, it's something the Reserve Bank talks about each time they publish their financial stability review. And they're generally referring to how far ahead is the typical borrower on their repayment cycle, either through using offset accounts or continuing on the repayment cycle without taking account of lower mortgage rates. So say, for example, if they have their mortgage at, when they originate at 7%, and mortgage rates have since fallen to, say, 4.5%, they've continued to pay at the higher mortgage rate just because they can. And they want to build up a buffer. What's happened more recently, though, is that about a third of mortgages, according to the Reserve Bank, who are utilising APRA data to make these assertions, about a third of borrowers now have negligible to no buffer in their mortgage repayments. And they tend to be investors, and they tend to be newly originated mortgages for obvious reasons. Investors want to keep their debt for the investment properties high so they can leverage, pay down the principal place of residence. For new mortgage holders, then they simply don't have the benefit of a repayment cycle to create a buffer. So that's one of the reasons. But you're absolutely right, Nicola. With most banks now requiring a 20% deposit, you find that there is quite a bit of buffer in that sense if values do fall. And there's going to be more and more focus, I think, on new originations having a deposit that's at least, say, 15 to 20% as the banks tighten up their risk policies. Okay, Phil. Sorry, Nicola, I hope that answers your question. I'll move on to Phil. You mentioned there's a significant amount of approvals in the next 12 to 24 months, but how much of that will actually be built? So this is a great question, and it's probably something I should have talked about a bit when I brought that slide up. So historically, when you look at apartment markets, between the approval of an apartment and the completion, there's about a 15% fallover rate of apartments that simply don't go ahead, either through lack of pre-sales, or they simply don't get the finance, or something goes pear-shaped with the actual construction activity. My guess is that 15% historical average is going to be much higher going forward, and we'll probably see somewhere like 25 to even a third of some of those approved product not actually transpiring into completed product. And that'll be higher in markets like Brisbane and Melbourne, where we do see these supply concerns most pressing. But despite that, if I flick back to what's currently under construction in these markets, it is still a lot of stock that's currently available, that's currently being constructed. That graph on the far right-hand side, you can still see my screen, shows the number of units that are currently under construction by state. And even though it's moved through its peak in New South Wales, in Victoria and Queensland, still rocketing higher in New South Wales, it's still absolutely at unprecedented levels, and all of that stock that's under construction obviously is going to settle. So that's where the risk is at the moment. But Phil's absolutely right that probably that worst case scenario that I painted on one of the slides showing how much stock we expect to come to the market isn't quite as bad as what that looks like, because you won't see all that stock actually proceed due to a whole bunch of reasons, mostly probably due to a lack of pre-sales and a lack of finance. Okay, I'll move on to Richie Regal. Interesting to see the strong population growth in Victoria, both interstate and overseas migration. Do you have data to show the spread of this growth, i.e. what percentage are moving to the city versus Geelong and Bendigo? I don't have those stats in front of me, mate, but once a year the ABS does publish the regional population data. It's about a year in arrears. And when you look at that data, it generally is the capital cities that are attracting the vast majority of that population growth. Some of the regional markets like Geelong, Bendigo, Ballarat, for example, even getting down to around the Bass Coast in Victoria, and the satellite cities, getting down to Geelong and so forth, have also seen reasonably strong rates of population growth. But you find, I'm just guessing here, but it's probably more like about 60 to 75% of that overall population growth will be taking place within the metro, the capital city, broad metro area. Okay, I might be wrong on that. I'll have to go back and check the numbers, but I'm just guessing. Okay, Julie, many thanks. Great. Peter, how would legislative changes with respect to reducing the intake of new migrants, such as changes to the 457 visas and lower intake of 189 visas, going to impact on the property market? Well, I think it will probably have some effect. When you look at the amount of overseas migration coming into New South Wales and Victoria, I don't think it's any coincidence that that's where the housing markets have been as strong as what they have been. Obviously, there are also the two states where jobs growth has been the most substantial, particularly Victoria as well. The last 5 years, New South Wales and Victoria have accounted for about 75% of all jobs growth nationally. So clearly that overseas population growth is going to the areas where jobs are available, but it's also fueling housing demand. So it really depends on the extent to which 457 visas and the overall population growth intake is affected by any policy changes. If it's dramatically cut, then you'd have to expect that there's going to be probably a fairly sharp reduction in overseas migration rates, which is going to affect overseas demand. Now, I'm not too sure what the split is between overseas arrivals moving into rented accommodation versus owner-occupied. I think it's probably got some bias towards rental, just considering the nature of that demand and that population growth. So in that sense, there may also be some implications for rental markets and occupancy rates as well. Okay, but yeah, it's still pretty speculative. There probably will be some further announcements around population growth intakes. I know that's one of the big discussion points around housing affordability is how much is overseas migration impacting on housing demand and pushing prices higher. Okay, and to Ben, what's the top 3 things the government can do that will assist with housing affordability whilst also not causing a significant market correction? Well, I think that has been debated so much at the moment, and there's so many things that the government should be doing. And probably important also to point out, it's not just the federal government, it's also probably more correctly state governments that could be affecting affordability. So from a federal level, at the very least, putting a housing minister in place, I think, would be quite effective. Somebody that's responsible for coordinating state-level ministers that are of the equivalent title, so somebody that's responsible for housing, and not just introduction of housing supply, but also coordinating appropriate zoning across the urban form. This is one of the issues with having 3 tiers of government. You have a local government that's responsible for zoning, you have a state government that's responsible for things like infrastructure, and a federal government that's responsible for the population intake. And quite often it's the case that each of those 3 levels are quite conflicted. You've got the federal government bringing in more overseas population, but the states have got to provide the infrastructure to support it, and the local governments have got to provide the correct zoning to ensure that densities can be upzoned to allow for high densities around transport zones and nodes and working nodes and so forth. So that's probably number one, is get some people in charge of the issue. Tanya Plibersek, by the way, was the last housing minister we've had at a federal level. The next thing, probably at the state level, is looking at stamp duty. You know, it is one of the major blockages to transacting in the market. If you look at the typical rate of stamp duty in Sydney, based on median prices, it's $40,000, and it's virtually the same in Melbourne as well, because the stamp duty rates are higher. That's based on the median dwelling price. So it is quite a blocker to first home buyers when you're confronted with such an obstacle. And the final thing I think is really important, and probably also very stimulatory for the economy, is get more infrastructure happening. There are plenty of affordable areas around each of the major capital cities that are simply undesirable because they're really hard to get to, and they're located remotely, and it takes a long time to get to pay people to where they work and where they play and where their families are. So opening up those affordable areas through better infrastructure, I think, is really important. You know, as we move out of this housing boom, we've already moved out of the mining boom. The next boom, probably rightly so, should be dominated by infrastructure spend, as well as, of course, tourism and agriculture and so forth, education as well. So probably those are my three top things, but they're all interlinked into a whole bunch of other stuff as well. But just do a Google search and you'll find that every man and his dog will have three other things that they think is equally important.
Well, thank you, Tim. Again, very insightful. We are blessed to have access to you. We appreciate that. I know that obviously several businesses, there would have been multiple people inside those businesses watching this presentation. So, you know, thank you again. It's terrific. We have recorded the presentation, so hopefully we'll be able to upload it and dispatch it to our many hundreds of members. For them to also digest when they have a moment in time to be able to do that. So we greatly appreciate your time again, Tim. Thank you for your support, for CoreLogic support as members of PIPA. And if you want to learn more about the products and services that CoreLogic offers through RP data and the like, you can obviously contact your local representative, state representative. As a PIPA member, you do get discounts on some of the products that are offered by CoreLogic and RP data. So I encourage you to explore them if you're not already doing so. They obviously have this macro data, but they also have ABMs and micro data, which will give you confidence around the areas that you're researching and potentially buying for your clients. So thank you again, Tim, for your time. Really appreciate it, and we look forward to doing another one of these at the second half of this year to see where that correction is going. Because I'm with you. I think we're at the top of the cycle now. So I suspect with the tightening of cost of money and so forth and sentiment shifting, that we'll see a reduction in regards to the marketplace on a whole. So it's going to get harder and harder to find those gems. So we look forward to listening to you or Cameron in the second half of this year.
Great. Thanks, guys. Good chat.
Thanks, Tim. So that concludes this webinar, everyone. Thank you very much for attending. If there's any other information or training sessions that you'd like, please let us know. You can contact Karen, who's our office manager. We plan to do more and more of these special events and training events as the association grows, to make sure that we continue to build out your professionalism in how you look after your clients. Have a great afternoon, everyone, and I really do appreciate you dropping by to get this market update from Tim and CoreLogic. Until next time, bye for now.